Going to get started. I want to welcome you for joining us today for our launch presentation on the latest developments on the employee retention credits. The employee retention credit can be a very beneficial tax credit for businesses that suffered gross receipt declines or were suspended by government orders in 2020 and 2021. The ERC is a very complicated tax credit, that's why you're here today, and the IRS is now starting to crack down on claims, leaving many businesses questioning whether they were eligible to claim it. So Tom, Chuck, and Randy are here today to help us better understand things and give us some directions if you filed a claim and if you're not sure if you actually qualified. I'm Carolyn Powell, Director of Development here at Tronconi Segarra & Associates, and I'll be your host today. There's a couple different ways you can engage with us. On the toolbar, it should be on the right-hand side of your screen. There is a question section. You can pop a note in there if you have any questions along the way, and we'll also save time at the end for questions. And then also too, there is a handout section that you can get a copy of the presentation and also full bios from our presenters. After the presentation, you will receive an email immediately after with a quick survey of how the presentation was, and then I will send an email this afternoon with a copy of the presentation, a recording, and again, if you want to connect with any of our experts. So without further ado, let's get started. Tronconi Segarra & Associates is a certified public accounting and business consulting firm. Tom is a CPA partner on our tax and SALT team, and it has over 23 years of experience. Chuck is a CPA partner on the accounting and audit team and has over 25 years of public accounting experience. And our special guest today, Lippis Mathias, is a full service law firm where Randy is a partner, where he focuses on complex tax controversy matters. As an IRS litigation expert, Randy worked for the IRS Office of Chief Counsel for 16 years and now works in private practice. So I'm going to hand it over to Chuck to get us started today.
Thank you, Carolyn. Appreciate the introduction. We're going to get started just recapping how the ERTC credit worked and the congressional acts that got us to the point that we're at. As I go through these first initial slides, I will talk a little bit about pitfalls that some people may have found themselves in, especially if they didn't use a CPA firm to assist them with the ERTC credits. If you are out there and you haven't actually filed for ERTC and you think you may qualify, please reach out to Tom or I, and we'd be happy to take a look at your circumstances and see if you do qualify. There's still time to file for 2020 ERTC. You have until April of next year. And then for 2021 ERTC, you have until April of 2025. So one of the common misconceptions that are out there is that there's something new from the IRS or there's something new from Congress that have made this credit even more expansive or lucrative. That was true, up until March 2021, and that is the last congressional act we had with respect to ERTC. Since then, the only thing that's changed is the IRS has issued some notices, and in most cases, they've made it a little bit less easy to qualify for ERTC rather than expanding the qualifications. And so, don't fall for the false advertising that there's something new. There isn't. Real brief, there were 3 acts. The first act was called the CARES Act. It was enacted right at the start or the initial phase of the pandemic. This particular act allowed for 2020 ERTC only if you didn't take a PPP loan. You had a choice. You had to either take PPP or you take ERTC. You didn't get both when that act was initially put into place. And it was allowed only for the year of 2020. It was allowed a 50% credit on qualifying wages. And the most you could get was $5,000 per employee, period, for the whole year of 2020. Then the Taxpayer Certainty and Disaster Relief Act came around right before New Year's in 2020. And this one was significant. It extended the credit through Q2 of 21. And for the 2021 portion of the credit, it required only a 20% decline in gross receipts as opposed to the 50% decline that was previously required for 2020. Increased the credit to $7,000 per employee per quarter. So very lucrative potentially in 2021. And I didn't mention this, but the 2020 portion of the credit, you had to have less than 100 employees. And for 2021, that was increased to 500. And most importantly, even if you had taken a PPP loan, you now were allowed to go back and take ERTC for both 2020 and 2021. You just couldn't double dip. And then the American Rescue Act of 2021 was enacted in March. This one initially extended the credits for 21 all the way out to Q4 of 21, and then it was subsequently modified back to Q3. So credits end for everybody at Q3 of 21 unless you are a recovery startup business or severely financially distressed business. In those situations, you could get the extra quarter of Q4. Okay, key provisions with respect to 2020 and 21 on the next couple of slides, just sort of comparing and contrasting. With respect to 2020, you would qualify either if you had a 50% decline in gross receipts in any quarter of 2020 compared to 2019, or if you were fully or partially suspended by a US governmental order related to COVID-19. And we'll explain that briefly. For 2021, as I mentioned, you still could qualify based on a full or partial suspension, but you only needed a 20% decline in any quarter of 21 versus 2019. So it became a lot easier to qualify. When comparing the credits, you know, again, for 2020, it's 50% of qualified wages. So if you had $10,000 of qualified wages for an employee, you could get $5,000, and that's the cap for the whole year. But for 21, it's 3/4. It's $10,000 per employee is the cap, 70% credit, so you can get up to $7,000 per employee per quarter. So this really can get quite lucrative for companies qualifying for ERTC in 2021. With respect to the number of employees, if you had more than 100 employees in 2020, you couldn't take the credit except for any wages paid to employees who weren't performing services. Think of those that might have been laid off who you were still paying, or those that you know, may have been getting health plan expenses paid for even while they were laid off. That would qualify as well. But for 2021, the limit was increased to 500 employees, and you know, that allowed the credit for a lot more businesses. We're going to skip this slide and go to partial suspension. So one of the common pitfalls that that we're seeing out there, you know, misinformation, is that, you know, anyone that had experienced any kind of governmental order, you know, whether it was from the CDC requiring the washing of hands or plexiglass separation between cashiers and employees, you know, qualifies for the credit. You know, that's not true. It has to be a governmental order that specifically related to COVID-19. It should be a US or federal, statutory or state, or a local rule. In most cases, for New York State, it's going to be the New York State pause orders. This is really the predominant orders coming from Governor Cuomo at the time. And it had to either fully suspend your business. So if you were a non-essential business and you were closed starting in March all the way through, in some cases, through July, that would qualify you during the period of suspension. Or if it was partially suspended, and that's defined as they had a suspension on a part of your business. And so that part of the business, in order to qualify for the credit, needs to be more than 10% of your gross receipts during 2019, or needs to include employee hours that were more than 10% of total hours during 2019. Always comparing back to 2019 pre-pandemic to kind of figure out what the story is in 2020 and 2021. So the businesses that often qualify for this are going to be, I'll just use the restaurant example. if a restaurant had a dine-in service and they typically did more than 10% of their gross receipts or had 10% of their employee hours spent in the dining service, and the New York State pause orders either had that fully shut down, or once you were able to open, you can only be partially open because you had to separate seats and you had to enact social distancing and capacity restrictions. That would qualify. That was a New York State governmental or New York State order. It impacted a part of the business that is more than 10% in 2019, and that continued all the way to June 14th, 2021. And so during that period of time that the restaurant was partially suspended in the dining area, regardless of the fact that they pivoted to takeout or delivery, they would qualify for the credit. And then I didn't talk much about gross receipts and qualifying in that manner, but that's pretty cut and dry. Again, if any quarter during 2020 was down 50% compared to the same quarter in 2019, or any quarter in 21 was down 20% compared to the same quarter in 2019, you get that irrespective of governmental orders. Okay. Another common misconception that's out there is supply chain issues. The IRS and Congress had some rules with respect to whether or not you were encountering supply chain issues, and this has often been sort of misapplied. So let's just talk about how it should be applied. If you were, especially like a manufacturer or retailer who's largely dependent on your supply chain in order to produce or deliver goods to your customers, and your supply chain or a significant vendor was under governmental orders from the U.S., not China, not some other entity, U.S. or state or local, and they were unable to deliver your goods as a result of that, and you did not have an alternate supply, and it caused you to be fully or partially suspended. So we got to go back and look at those rules with respect to more than a nominal portion or more than 10% of your business being suspended. Then you could apply the supply chain rules and qualify for ERTC. What would not qualify, again, would be supply chain issues resulting from macroeconomic issues like lumber, steel, semiconductors, supply chain issues resulting from the chaos that was happening in China, supply chain issues where you were able to find an alternate supply and therefore you weren't fully or partially suspended, you're still able to deliver goods to your customers, or supply chain issues that didn't impact more than 10% of your business. So again, if you were able to pivot, even though you could have done more business had you had more supply, that still doesn't qualify. This is really looking for situations where you could not get the supply, had no alternative, and it had a significant or more than nominal impact on your business.
I think, Chuck, this was one of those situations too where they're provided a very narrow, limited exception in this case. The IRS has published guidance on this as well. I mean, I think a lot of people have fallen victim to the scenario where, okay, you had a supply chain disruption, but by itself, that's not going to rise to the level of a full or partial suspension because there's no government order. I mean, you had a supply chain disruption that's terrible, but if there's no government order issued with that because of COVID, that's not a suspension. You can't qualify for the retention credit based on that. I think that's a very common misconception out there.
Absolutely, Tom. You really need to, if you haven't applied yet, or even if you had, if you applied under supply chain, and you really can't point to the vendor that was under governmental orders and the specific order they were under, and how you couldn't find an alternate supply, and how it impacted more than nominal portion of your business, you're probably going to want to speak to us. And that's part of the point of the presentation today is, for those that haven't applied, be very wary of mills that are touting this as a way to get into the credit. But for those that have and maybe use supply chain, we can try to help you navigate those waters. But this is definitely a on the IRS's radar as a fraudulent application of ERTC. All right, another common misconception that is out there is that if your business has a separate EIN from another business that you also control meaning more than 50%, then you can look at those businesses in silos. That is not true. If you, or let's say you and your wife, for instance, or you and a significant family member control more than one business, the rules are that significant family members or spouses are kind of considered the same as you. So to the extent that in the aggregate you control more than 2 businesses or 3, meaning more than 50%, then those businesses need to be combined when considering whether or not you qualify for ERTC. And this can be good, and this can also be bad. So number one is when you're looking at the full or partial suspension of due to government orders, when you're applying the more than nominal test of 10%, you've got to be applying it based on aggregate gross receipts of both businesses combined. But if one business was fully suspended, or if you do meet the nominal, if they were partially suspended and you meet the nominal test, both businesses are going to qualify for ERTC, which is great. When you're looking at significant decline in gross receipts, you're going to be using aggregate receipts of all businesses controlled combined. That can be good, and that can also be bad. If one business suffered and the other one excelled, maybe you won't meet the test. But if in the aggregate you meet the test, then both businesses will qualify, or all businesses will qualify for ERTC. This next bullet point, maybe a little more punitive. When you're looking at the number of employees, 100 in 2020, 521, all businesses controlled need to be aggregated to come up with this number, and that often can be punitive. And then also, if you have employees that work in more than one business, the maximum credit, which is $5,000 in 2020 or $7,000 per employee per quarter in 21, needs to be applied regardless of the fact that they may be earning wages from more than one business. So what we're seeing often is the ERTC mills are ignoring these aggregation rules, not asking the right questions, not considering this, and this can land you into some hot water. So make sure you're appropriately applying these rules. They are complex. I know this is probably clear as mud, but we can help you through this. If you haven't applied yet and you want to make sure you're applying these correctly, or if you think these were misapplied, we also are here to assist. PPP loans, a common misconception is that if you took PPP, you can't get ERTC. That's not true. You can get ERTC in both 2020 and 21, even if you took loans in both years, but you can't double dip on wages used for forgiveness with wages used to calculate the credits. Again, something that's completely ignored by the ERTC mills. They don't ask questions around PPP. They don't do calculations. They just sometimes pretend this didn't exist, and that will land you in hot water. So got to make sure there's no double dipping going on. And so, here at Franconi, we use a complex calculations to not only make sure there's no double dipping, but also to make sure we apply your wages used for forgiveness in the most strategic way to maximize your credits. And then finally, before I turn it over to Tom, just a reminder, again, the ERTC mills that may have done credits for you won't tell you that you have to go back and amend your federal returns to reduce your wage deduction that you took in the applicable years of the credit. So in other words, if you took credits for 2020 ERTC and also 21 ERTC, both those years' returns need to be amended. Both the business return, and to the extent that you have K1s, the K1s will need to be amended, and also the personal returns will need to be amended. The end result likely will be that you'll pay additional tax based on the fact that you have less wages to deduct due to the credit. You still are better off taking the credit than not. You're still going to end up getting a tax of, let's just say, 30 to 40%, but still worth it. But this is often overlooked. So if you're out there and you've taken the credits, but you haven't amended your returns, do so right away. This is very easy for the IRS to catch. They can easily run an algorithm that says, did you get ERTC credits? Do we have amended returns on file? If no, you're going to get a letter and it's going to put you in hot water. Don't wait. Make sure that this is done right away. You know, there is a theory that you should wait until you actually get your money before you amend your returns. We won't take issue with that, but once you've got the money, make sure you amend your returns right away. And so, you know, raise your hand out there in the audience if you need help with this. Contact your CPA right away if you haven't done this, but don't sit on this. This is easy picking for the IRS, and they will identify this. Okay, great. Let's talk about scams. I'm going to turn it over to Tom.
Yeah, thanks, Chuck. And I think a large part of why we're here today is to talk about what's been going on with the employee retention credit. And largely it's due to the IRS actions, considering all the woeful and shameful scamming and, you know, lack of equitable marketing that's been going on regarding the retention credit. It's funny, I look back and I can see the first time the IRS started warning taxpayers was probably in the fall of 2022, around October, that they should be concerned about third parties, you know, presenting improper retention credit claims. And after that, it just kind of seemed like every other month there was a new warning. In March, they added the retention credit to the Dirty Dozen list of tax scams, which, I mean, Randy, you would know, I mean, the people on that, the promoters that they go after, those are some of the worst tax scams the IRS sees out there. May was another warning to businesses. July, they said we're stepping up our monitoring on this, and you know, they started listing signs of aggressive marketing. I mean, if you're getting emails and texts and calls from people, you know, any types of statements that they can determine your eligibility for the credit within minutes, that's impossible, especially if you took a PPP loan. How do you know how much wages you use for forgiveness? That those wages don't qualify. If you had a promoter listing large upfront fees, we've seen anything from 15 to 25% of the claim that they want paid up front. Anything like that, I mean, it is a sure sign that you really, really want to be careful about using this person and claiming your eligibility for the credit. I mean, everybody knows, they heard these ads on the radio. I had to turn off WGR half the morning, just Howard Simon was shilling for retention credits. I mean, TV, I get emails every day, and the worst were the letters that we've seen in the last few months that look like IRS notices, you know, basically stating that you're eligible for X amount of dollars of credit, and that they look like a government letter. You know, the most important thing we could say about that is you really got to be careful who you work with, and really choose a trusted tax professional, whether a CPA or an attorney, to really help you if you're still debating whether or not to file or claim the credit, or now you have questions after seeing all this and after what you're going to hear today as to your eligibility.
And yeah, Tom, that's a point well taken. And on that Dirty Dozen list, key thing to take note of, the IRS is not saying that the ERC credit is an abusive tax avoidance transaction. Rather, what they're trying to alert taxpayers and practitioners of are these mills that are out there that are doing certain things that you guys both talked about right now, where they're abusing the statute.
Yeah.
That's the key thing. And there's so much of it out there that the IRS felt the need to issue that notice.
Yeah, I don't think I've recalled in 25 years of the IRS really going after anything, even tax shelters, as hard as they've done this over the last year or so. It's really something else. So just to add just a little bit of context here before this slide, just so you know, the ERC, as of September of 2023, the IRS says they've paid out $230 billion in retention credit claims. Originally, the CARES Act, the Consolidated Appropriations Bill, and the American Rescue Plan budgeted $85 billion in appropriations for this. So that's almost 3 times as much as the Congress originally appropriated for this credit. There's been 3.6 million claims filed. And currently, the IRS is sitting on a backlog of approximately 1.3 million unprocessed 941X, the amended return for this. So people are still filing this even after on September 14th, when the IRS commissioner announced there was going to be an immediate moratorium, at least until the end of the year, on processing new claims. The IRS felt that the number, the influx of claims, roughly like $600,000 in the last 90 days, so like in June, July, August, September timeframe, they felt there a large part of those were fraudulent or suspected to be fraudulent and ineligible, mostly due to the actions of aggressive promoters and solicitors. So the IRS said, hey, we're stopping reviewing new claims. And even then, if you think about it, there were 600,000. There's been an additional over 400,000 filed since then. So they're sitting on a huge backlog of claims at this point that they're still trying to process. So they are continuing their activities if you filed your claim prior to September 14th, but those processing times that we saw go down, Chuck, right? We saw our clients getting, their credits, their notices from the IRS roughly 90 days or so. That time frame is going to double essentially to about 180 days and much longer if the claim faces internal scrutiny or review by the IRS. So you can expect if you filed the claim, just hold on. They are looking at it. It is just taking more time because of all the fraudulent activity that's out there. So in September, the IRS did also say where they're going to launch a couple new initiatives to help businesses who may have found themselves victims of these aggressive promoters or mills. There's going to be a special withdrawal option and then a settlement program. So as of right now, we've heard about the withdrawal process. In October, the service announced some details, and you can see here we have them highlighted. If you in blue, those are links you can go and to the website. They issued some information about this with special withdrawal process to help those who filed claims and are now concerned about their accuracy. Really, if you meet these categories, you can go through this withdrawal process, and there's a few different options which I'll talk about. But businesses have to have claimed the credit on an adjusted employment return. So essentially, that's your 941X. Your 941 is your federal employment tax return that's due quarterly. The 941X is where most people would have claimed it. You've had to, filed an adjusted return only to claim the ERC. If you had other adjustments on there, you can't use this withdrawal process. You have to want to withdraw the entire amount of the claim on that quarterly return. It can't be a partial. You have to withdraw the entire claim, and the IRS cannot have had paid your claim. Or if they paid the claim, you haven't cashed the check yet or deposited the check. So if you meet all that criteria, you can use the special withdrawal process. Otherwise, the IRS advises to file an amended return, which may or may not be a good idea at this point, considering there's some potential options coming down the road as well with that.
Yeah, Tom, just a quick note on this, and it's going to become more apparent in your slides to come.
Yep.
But, the thing is, this withdrawal process is not a guarantee that against penalties.
Mm-hmm.
That's the big concern. And you want to always be mindful of the fact that if you do file an amended return under this protocol, you're giving up the whole credit.
Yeah.
So what you're really telling the IRS is, I claimed the credit, and now I know you guys are coming after us, so now I'm not claiming it. And it could be deemed by the IRS to be an admission.
Mm-hmm. So
what I would strongly suggest is that anybody who goes through the withdrawal process, do so with an advisor, a professional advisor that can walk through the protocol, because as Tom's going to show in the next few slides, there's reasons why the IRS wants certain information on the withdrawal forms, and they're not necessarily for good reasons for taxpayers. So, but that's a point. So you know, if you use, like, for example, what we would do if we were helping somebody go through the withdrawal process, we would make sure that in that package, they explained why they were doing that. In other words, they came to, you know, Tronconi or Lippis or somebody and asked, hey, can you vet this ERC claim? And if the new advisors or the CPA came in and said, no, I don't think this is right, that's your reason for withdrawing, not because you realize that the IRS was coming after you. You would go in and get another sort of a second opinion.
Okay. Yeah, I think that's important coming up. You can see here on this slide, there are different steps or procedures to request this ERC claim withdrawal. So there's really 3 different scenarios that the IRS has listed out. The first scenario, you haven't received a refund and you haven't been notified your claim is under audit. The second scenario, you haven't received a refund and you've been notified your claim is under audit. And then the third scenario is you received a refund check, but you haven't cashed or deposited it. I think that one is really touch and go, because I don't know a lot of people who haven't gotten their checks and, you know, deposited those right away into their bank accounts. Now, it's interesting, Randy, because they do state that if you withdraw the claim, it's going to be treated as if it was never filed, that they're not going to impose penalties or interest. But I think we say in a later slide as well, the IRS kind of says that, but then they also say that if you willfully filed a fraudulent claim or assisted or conspired in that act, withdrawing the claim is not going to exempt you from potential criminal investigation or prosecution. So you might get out of a penalty, but they're still going to potentially come after you if they believe you filed a fraudulent claim. Is that correct?
Yeah, I mean, and it's clear. I think you've got there's a slide later on in here that it explains that the IRS could, believe it or not, reject a withdrawal. In other words, they could say, yeah, okay, we know why you're coming in here, and we're going to reject that and continue on and pursue, you know, whatever it is.
So this withdrawal process, it's no guarantee.
With that, if they can reject a withdrawal, it's no guarantee. But that's really the case with any of the other voluntary disclosure programs the IRS had over the decades, you know, whether it's foreign bank account reporting, things like that. They always say this is not a, you know, an amnesty program, so to speak, or a get out of jail free card or something like that. But they are giving people the opportunity to go in and do their due diligence if they used one of these promoters, and go in and have somebody else vet the claim and see what they should do. That's what the explanation should be.
I think it's important to note too that if you use a professional payroll company to file their claim, you know, your employees are in a PEO or any type of agency like that, you really have to talk to them about then going back and taking care of that claim, because they're filing your claim along with the claim of other businesses, you know, whose employees that they have it on their books. So they can't use this withdrawal process. They would have to amend. So God bless them, any of the PEOs out there, because I can't imagine the difficulty that's going to bring them if they have to amend multiple returns times over, because now these companies are coming to them and saying, hey, you know, we want to withdraw, we want this out. It's going to be very difficult on that end. So that's something to note. Just real quick, just some details on these 3 different processes. Just some basic facts from the IRS, and this guidance is online as well. So those 3 scenarios we talked about, you haven't received a refund and haven't been notified your claim is under audit. Very simple process to withdraw. Make a copy of the amended returns that you filed, and then now you want to withdraw. In the left margin, just write the word withdrawn. In the right margin, have an authorized person sign and date it and write their name and title. So now that's giving the IRS the person that they're going to be contacting about this potential issue. And then once you do that, you simply fax the signed copy to the IRS at the number here. And you remember, you are withdrawing the ERC for the entire quarter, not just a specific part. So, I mean, it's very difficult, especially if you filed multiple returns for multiple quarters. You know, you could have to do a few of these at that point.
Yeah, and it gets really messy and really tricky really quick, because if you're, and again, as we talked about before, there's a reason why the person has to sign over there on the side of the form. This is a 941. And if you amend and you're paying back the credit or whatever, you're going to owe money. It's going to be trust fund money from your 941 and employer contributions, theoretically, on, once you do that. And in that regard, you may have a liability. Let's say the company did in fact suffer from COVID, from the pandemic, and had a business downturn, is maybe out of business today or whatever. Now all of a sudden, you've got a responsible officer on the side of that form signing their name to it as responsible as an officer of the company. So there's a lot that goes into this. I know we're going to talk about.
Yeah, the IRS isn't just being straight up benevolent here and finding they want to know who's responsible as well if they have to go after that party. So the next slide, just real quick, the second different option, if you haven't received the refund, you've been notified your claim is under audit. Essentially, they want you to prepare that adjustment request, that withdrawal request that we talked about in Section A, but you're not going to submit it. You're not going to fax it or mail it. Instead, if you've been assigned an audit examiner from the IRS, obviously you want to communicate directly with your examiner about how to submit the withdrawal request to them. And if you haven't been assigned an examiner yet, you want to respond to your audit notice with the withdrawal request. So there are some options if you've been selected for audit directly on the retention credit that you've been given. So, and then finally, which I think is the toughest one of these, in the sense that I don't know how many people out there have received their checks but haven't cashed or deposited them. Again, you're going to prepare a claim withdrawal as we talked about in step A, but you're not going to fax it. You're going to include it with your check. You're going to write void on the check in the endorsement section. And I find this next one is include a note that says ERC withdrawal and briefly explain the reason for returning the refund check. So again, you're providing, documentation to the IRS as to why you're withdrawing this retention credit claim now that you've been paid for it, which.
Yeah, this is an anomalous situation, because on the IRS transcripts, they're going to show, when they cut that check, giving the refund, that's what shows up on the check. It's not when the check is when it's deposited, that kind of thing. So they do need that explanation, because it's going to be the rare taxpayer that got the money, the check, and then held on to it and didn't deposit it. So it is, I think this is going to be a rare situation, but again, the forms provide for the taxpayer explaining why they're withdrawing. That's the key thing. And when the IRS gives you that opportunity, whoever's helping you through the process that's where you're going to really get away from penalties and explain your situation, and they're giving you that chance.
And then just a couple slides, I want to turn it over to Randy to talk about some more. Again, I think we've said it a few times, just filing this withdrawal request isn't enough. You will it's not effective if you get an acceptance letter from the IRS. If your withdrawal is accepted, if you had already amended your returns, like Chuck talked about earlier, to account for the ERC, you may have to amend them again to revise that business wage deduction. And then it's also good to note there, that second part, that special voluntary disclosure program, I think they kind of stated it slightly, but not directly, that that's going to be announced later this month, that there's going to be another method. If you got your check, you cashed it, you deposited it, now what do? How do you give that money back? So I think we're going to be waiting on and expecting the IRS to issue some guidance on that before the end of the year, which will be very interesting to see what happens. And then finally, my last slide I'm going to talk about, just last week again, on December 6th, the IRS announced it was sending more than 20,000 letters of claim disallowance letters to taxpayers rejecting questionable retention credit claims as they continue to combat these scammers and promoters. So basically, this review, this time that they're taking right now, that's, since September, has already resulted in 20,000 letters going out. And these are just basic categories of why they're being disallowed, such as the entity was not in existence, or there was no paid employees during the period of eligibility. I mean, that's 20,000. If you think about it, that's the size of the arena downtown. That's how many people have received these letters already. So, and they expect to send additional letters. The letter will have, the disallowance letter will give you an explanation, provide information how you can appeal if you believe your credit is eligible. So,
Quick question on this. You mentioned earlier the scam letters. How would you differentiate if you're getting an official letter or a scam?
the IRS is not gonna send you anything saying, hey, you're eligible for this credit. I think you need to know that off the top, that you're not gonna get anything directly from the IRS. It would have, if you did, it would have the Internal Revenue Service name, address, and everything on it. These letters just looked, we should have included one of these. They look, like, I could spend 5-10 minutes looking at the one going, what is this? But you'll see the address. The address is from, or the callback or the email is from some private company that's promoting retention credit claims. It's very slick though. It looks good, so.
Yeah, I would go based on the assumption that it is a scam. If the letter is saying, hey, we're the IRS and we looked at your return and determined that you're eligible for the credit. IRS doesn't do that. They're not, that wouldn't happen. As benevolent as the IRS is these days, they haven't resorted to that yet. So.
Great,
okay.
thanks guys.
Yeah. Okay, Tom, thanks. And just a couple of things, if we can go, oh, yep, the moratorium slide. Chuck and Tom talked about the IRS moratorium on processing claims. And that's still in place. They did very nicely disallow 20,000 claims, as Tom said. But those are claims that it's a tiny fraction, even though that's a lot, it's a tiny fraction of the million or so claims that are still out there. But what it does show is that the IRS is trying to figure out how it can use its data analysis capabilities, which are expansive, to figure out whether to go in and see if they could figure out and weed out abusive claims from meritorious claims or claims that may have shades of gray, okay? And that's what they're struggling with now. That's why they took this dramatic step toward a moratorium. The moratorium is extreme because the IRS is charged with processing tax returns. That's their function. You file your tax return, they process the tax, they send you any refunds that you're owed, and if there's a question with it, they audit within a statute of limitations, okay? This moratorium is somewhat unprecedented, and it goes against their standards of practice on the IRS side. But as we talked about earlier, it's attributable to all of the things that are going on, the fact that this is on the Dirty Dozen list. They are seeing this, And the problem that they're encountering is because of the tight timeframes
Mhm.
in applying the years that are involved, the statute of limitations that are in place. This is not something that occurs over several years where they can catch people, you know, in the beginning or at the end of a program, like at some other abusive arrangements. They have a limited time frame to nail these things, and they know they can't possibly audit 1 million returns. So that's why you're seeing this. So thing is though, it's muddied the waters, the moratorium, and we can go to the next slide. And it's created important things that taxpayers have to consider while they're sitting and waiting on their claim. If you've got a claim pending, you should be consulting your advisors and asking questions about certain things. For example, the most important thing is, remember that you likely, if you're the taxpayer, amended your business income tax return and associated K1s, K2s, K3s to reduce the deductions for wages that are associated with the claim, okay? IRS has a longer period of time on the statute of limitations by statute to go after the ERC claims than you have to amend your amended return to recapture the wages paid. That is a pitfall. And if you wait too long and don't file even a protective return on those wages, you could find yourself in a situation where 2 or 3 years from now or whatever, or less than that, your 2020 return that you amended is now time barred, and you could lose the ERC and lose your wage deduction. So what do? Do you go in and file a claim for refund now, raising your hand and saying, hey, by the way, IRS, I think I made a mistake on my ERC credit and I want my wages back? Or do you say, I'm preserving the whipsaw. I don't want to get whipsawed on both ends. You haven't processed my claim. I'm going to, just to protect myself, file an amended return claiming this so that I don't lose out on it. A delicate thing, but an important thing that has to be considered. And my sense now is that there's a little bit of time to wait, but you do not want the statute to expire under 2020 year at all. And I will say that even if your claim was processed and you got your refund, because technically they can still go in, as Tom said, and audit that claim and claw back the refund. So that's an important thing. And the other important thing is, if you do have your claim pending right now and the IRS is waiting on it, there's a statute of limitations to contest a claim disallowance. You'd have to file a suit in federal district court, but you can file that even if the IRS doesn't act on the claim. So if the IRS is sitting on this claim right now through the moratorium, if 6 months goes by since the date you filed it, you, at any time after that 6 months, before they disallow it, you could go in and file a claim in federal district court demanding that the court hear the refund. So if you really feel strongly that you're not among the claims that the IRS is saying are bad, you have a remedy. You don't have to sit on your hands and worry about that and fret, especially if your business is suffering, you know. So that's some points on moratorium. Again, watch out for the pitfalls. With respect to voluntary disclosure programs, Tom covered that nicely. And the only thing I would say to add to that is that you can bet that when the IRS comes in and locks down the terms for the program, some of the things that they're going to do are they're likely going to ask for information on the promoter. They're going to ask for you to give them the contract. They're going to ask, as we've seen, for an explanation as to why you're coming in and amending and you know, or going into this program, I should say. The newer voluntary disclosure programs, I think where they're struggling right now is trying to figure out terms. What are we going to do? Are we going to have it like the old tax shelters of the 80s and 90s where we'll give you 75% of your claim versus 100% of it, or we'll knock out penalties or things like that? I think they're trying to formulate terms that people will come in, you know, that facilitate them coming in. The problem that people have right now is that if you paid a promoter a percentage of tax savings, that doesn't jive with IRS. You pay, typically you pay somebody hourly to do your tax return, things like that. A percentage of tax savings doesn't fit into this mold, because somebody would come in and say, well, wait a minute, I had to pay my guy 30% of this, so I'm not getting any deal if the IRS discounts my thing by, you know, my refund by 30, because I lost that anyway. So, you know, it's once the terms are there, you know, what I would recommend is go and talk to either, you know, Tom or Chuck or your advisor and say, where am I? How do I fit into this? And should I come into the program? That discussion has to be memorialized. That's your explanation in, and that's what's going to be able, that what you're going to be able to rely on in addressing penalties, things like that. Okay,
Yeah.
with the IRS.
That's a good point.
So a delicate thing, because if you come in, especially if you withdraw, like I said before, that's deemed an admission. If they're going after you criminally, if they're linking you to some promoter that's abusing the system, which they are, there are hundreds of thousands of claims out there like that right now. It's what you did back then that's subject to criminal exposure, the investigation, civil fraud, things like that. You cannot unring that bell by coming in and withdrawing it and saying mea culpa, you know.
Yeah.
But what you can do is you can go in, and if it's vetted by somebody and you look in, you listen to them, and let's say I say it or Tom or Chuck, and we say, you know what, maybe you were entitled to a lesser claim based on the aggregation rules, based on, you know, the different factors that Chuck was talking about earlier, and you correct it based on somebody else's guidance. That's using due diligence, okay? And that could absolve you from penalties. So that's an important thing. Jumping to the ERC examinations, okay? They're out there, they're starting, and we're starting to see how they're being processed. Just a key thing, I'll give you an example of how sensitive these examinations are. The first IDR question, information document requests, the IRS has pro forma document requests for these audits, is guess what? How much did you pay someone to do this? What was the formula that you used? Who was it? And give us a copy of the contract. Okay, they're looking for promoters because they can't really find them, because on the 941, like what you guys showed on the screen here, there's nowhere for a preparer to sign. It's typically filed by the business. So it's difficult for the IRS to identify who prepared the return and go back to the hub rather than the spokes. So they're using their data analytics process. I was just at a conference talking to other practitioners and people at IRS. They feel confident that they can, based on trends in the claims and things like that, actually figure out ways to go back and find who's been preparing these returns, and then find audits based on that. Okay, so that's an important thing.
There's one bad apple in there that they're going to get. The whole batch is probably, you know, those returns prepared by that promoter are going to be suspect.
Exactly, and they're going to be volumes, you know, because it's easy to do, you know, cookie cutter claims like this for everybody, and that's what they think is out there, the IRS, and so that's where they're going. The other key thing is they are going to ask for taxpayer interviews, CFO, controller, tax department, HR, you know, for payroll, who knows who else. And they want site visits. My policy generally in, especially in dicey cases like this that we kind of colloquially referred to as HL audits.
Mhm.
If they're looking at you and really scrutinizing and there's a worry, the people don't get interviewed. Any questions would come through counsel, and we would work through answers in written form to the IRS through counsel. So I would advise strongly against having your people come in and do interviews with IRS, because frankly, they don't know the law. They know what they're good at in these different functions, but they're not going to understand, and they may say something that the IRS misunderstands, et cetera. Site interviews may not be so bad, and I don't know that you can really stop them from asking for that or obtaining that, because you may want the IRS to see your business, place of business, to see, like for example, a restaurant or something where there's close quarters, because that may show how everything adversely affected the business. The other big thing, if we go to, that's great. We can help. I think one area where we can help is through doing sort of mock audits for these programs or for these examinations that are to come, because we do know certain other things that they're asking. The gross receipt aggregation and shifting among quarters, that's a big focus. Eligibility, employees, qualified wages, double dipping with PPP loan, everything Chuck talked about. The IDRs are designed to gather that information. And the more you can use best practices, have all that stuff available today, have your answers ready today, walk through everything, have them packaged up, have it on your system. So when the IRS comes in, you've literally answered the IDRs years before. You will not be scrambling if they come in 2 years from now, and pick up your case for audit.
Yeah, who knows if you have turnover, and
People don't remember.
Yeah.
Right, that institutional knowledge is key, especially during the pandemic, because you're losing people all the time. And if you lose that institutional knowledge of what you were going through then in 20 and 21, that's pivotal. That's pivotal. Last quick thing I'll talk about is there was an OPR memo that was issued in early 2023, and it really sends sort of a mixed signal to taxpayers and practitioners. But the bottom line is that I think the IRS is saying, look, you can have a legitimate claim for the credit. That it is a lawful thing. And a practitioner can't say, well, the IRS is looking at this, I'm not going to file your claim. Practitioners like CPAs have an ethical obligation to their clients to file claims. Problem is when you're amending the return, the 1120 or the business return, even if you didn't prepare the claim, the issue is going to be that the CPA amending the tax return implicitly blessed the claim, the ERC claim, to coordinate the treatment. So it's the memos and the guidance, especially, as you guys said, send mixed messages. There is confusion. This is a gray area. And so if you get a notice or you're worried about your claim, don't jump to conclusions. Call Chuck and Tom, and have somebody look at this and vet the issues.
Great, thank you. That was a lot of good information and direction that you were able to provide people. We have just another minute or two. If you have any questions, pop them into the question section. We'll get those answered for you. While you're doing that, I'll just touch on the fact that you will receive a survey immediately after the webinar, asking for feedback, and if you would like to set up a call or meeting directly with any of our experts today. So if you want to fill that out, and then later this afternoon, I will send you an email just with the slides again, so you have another copy of them and the recorded version in case you want to go back and re-listen to something or share it with a colleague or somebody else that needs this information. So I'll be sending that out. Also, too, we have a webinar on Thursday this week, the 14th, 2023 year-end tax planning strategies and preparing for the tax season. So if you haven't signed up for that yet, feel free to do it, or let me know if you need the link for that. And otherwise, we are going to wrap things up today. Thank you again, guys, for all your expertise. I'm sure we'll be hearing more about this in 2024. So,
Yeah, and thanks, special thanks, Randy.
Yeah,
coming
thank
out.
you, Randy.
Yeah, working with us on this. Appreciate your expertise and knowledge of how the IRS works with this stuff. Sure, we're gonna be working on a few of these together going forward.
My pleasure. Interesting times, no doubt.
great. We'll keep everybody posted as more things develop and get you the information that you need. Thank you for joining us today.